Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. Now, please remember that none of this is investment advice. It's for education and engagement purposes only. And when investing, please understand your own risk tolerances, time horizon, and your investment objectives, and then invest accordingly. And this week we'll also have Q&A based on the questions submitted by you, the viewers. But before that, we'll be taking a look at one indicator that investors should always keep an eye on. And that's the index of bond volatility that many of you may know as the MOVE index. It's a bit like the VIX but for fixed income. And we follow it because rising bond volatility is one of the key triggers for policy intervention. In fact, it was a spike in bond volatility rather than weakness in the equity markets that focused minds during the COVID crisis. And a basic rule of thumb is that markets are generally undergoing a period of relative calm when the index is under 100 and vice versa. And currently, it is the case that the index is below the 100 level, although the index is approaching 100 once again. And with expectations for further rate cuts at the December Federal Reserve meeting, it's anticipated that bond yields should drop further, keeping a lid on potential volatility. Recently, however, both the dollar and the MOVE index have started to rise together, implying that risks might now be also rising. And whilst interest rates are expected to fall, longer dated yields remain stubbornly high. And you can see that gap that has opened up between the 2-year and the 10-year yield. And historically, the US has experienced recessions during periods when that gap has been widening out. But so far, there's been no recession, and policymakers stand ready to react if the economy does start to falter. But what if the market issues are beyond the control of the US? You see, Japanese yields have squeezed to another 10-year high after the announcement of their $110 billion support package. And the dollar has strengthened against the yen. The risk looks skewed to more dollar strength and yen weakness. And all this matters because global markets are so intertwined. Higher Japanese yields can drive up US yields. Volatility in the yen can impact capital flow from Japan that's supported so many global markets over the years. And a rise in the MOVE index may therefore be an indication that these global flows are at a critical point in time. So whilst global markets look calm, many investors have been adding long US dollar positions as a hedge to this uncertainty, even whilst US interest rates are expected to fall. And with that, let's now look at some of the questions that we've received this week. The first question is, if the US Federal Reserve cuts rates at the December meeting, will they maintain a dovish bias into 2026? Well, the next meeting will also get the updated dot plot of rate predictions. Currently, it shows an easing bias through next year. And given the underlying stresses discussed earlier, the Fed is likely to maintain this bias. And they may even highlight the other policy tools that they can use to reduce market stresses, should they now arise. Therefore, they should maintain a dovish bias into 2026. And a follow-up question to that one was, would that easing bias put pressure on the US dollar? Well, as we've seen, the dollar has been in an uptrend against many other currencies recently. And if the US is cutting rates because global risks are rising, then the dollar could easily be seen as a safe haven, which has generally led to a stronger dollar. In fact, the dollar is more likely to come under pressure during periods of strong global risk on, rather than periods of risk off. Now switching to equities, we have the question, is the US equity market a bubble at risk of collapse? Now, on most metrics, the US equity market does look stretched, but it's not ridiculously overpriced. It is highly concentrated in a few themes, but as long as those stocks continue to attract that capital because people like those themes, then these stocks will obviously still be supported. The biggest risk to equity markets is therefore probably the risk of that bond market volatility that we discussed earlier. And finally, we turn to the crypto arena. Will increased global liquidity in 2026 be beneficial to Bitcoin? Now, whilst there's no guarantee that we get more liquidity next year, if we do, then the simple answer is yes, because Bitcoin is at the center of that liquidity risk-on, risk-off matrix. If policymakers preemptively provide new liquidity, then Bitcoin, along with other high beta assets such as tech stocks, should do okay. However, policymakers have not yet pulled those liquidity levers, and they may not need to.